Loans and mortgages can feel like a maze no one ever really explains. Maybe you sat there scrolling, wondering, how the heck am I supposed to afford a house? Or, what even is interest? But here's the thing, understanding loans isn't just for bankers or experts. It's for anyone who wants to take control of their money and their future. In this video, I'll walk you through everything from what loans actually are to the types of loans, interest rates, how to qualify for a mortgage, and the whole mortgage process in a way that makes sense without the confusing jargon. So what actually is a loan? Well, at its core, a loan is borrowed money you agree to pay back over time with interest. It's one of the most important financial tools for both individuals and businesses. The principal is the original amount you borrow, and the interest is the extra cost lenders charge, usually a percentage of that principal. Your payments go towards both of them. So loans come in two main types, secured loans and unsecured loans. Secured loans are backed by collateral, like a car or property, so if you can't pay, the lender can claim that asset. Unsecured loans don't require collateral, but usually have higher interest rates because the lender takes on more risk, since the lenders can't claim assets. Loans can come from banks, credit unions, companies, or even governments, and terms vary based on who you borrow from and your financial profile. People use loans for everything, from personal expenses and emergencies to business investments and big purchases. Not all loans are created equal. Different types exist to meet different financial needs. The right one for you depends on your eligibility, budget, and long-term goals. Conventional loans are the most common. They're offered by private lenders. They typically require strong credit and a larger down payment. The reward? Lower interest rates, but the trade-off is stricter approval standards. Government-backed loans, on the other hand, are designed to make borrowing more accessible. The Federal Housing Administration loans allow lower down payments and credit scores. Veteran Affairs loans help veterans and service members buy a home with no down payment. And the U.S. Department of Agriculture loans target rural buyers with low to moderate incomes. Then, there are special programs, often run by states or local governments, offering loans or grants to first-time buyers, public service workers, or specific communities to encourage home ownership. Finally, loan terms matter just as much as the type of loan. 15-year terms mean higher monthly payments but less interest over time. 30-year terms stretch the payments out, making them more affordable month to month, but they cost more in the long run. And the choice is often determined by someone's financial status. Here's the thing, even if two people borrow the same amount, their costs can be completely different. Why? It all comes down to the type of interest rate. A fixed interest rate is like locking your loan in a time capsule. It stays the same from start to finish. Your monthly payment never changes, which makes budgeting easy and shields you from rate hikes in the market. An adjustable rate works differently. It starts off with a lower tempting rate for an initial period, but after that it changes with the market. If rates rise, so does your payment, and without careful planning, that can hit your budget hard. The bottom line, higher rates mean more money out of your pocket every month and over the life of the loan. Lower rates save you money, but lenders may demand stronger credit scores or stricter requirements in exchange. So loans can feel like magic. One signature, and suddenly you have the money for that house, that business, or that new car. The magic always comes with fine print. Let's break it down. On the plus side, loans open doors you couldn't unlock on your own. They let you make big moves now instead of waiting years to save up. Pay them back on time, and you'll not only keep what you bought, you'll also boost your credit score, which makes future borrowing easier and cheaper. And if it's a fixed rate loan, your payments won't play any nasty surprises on you each month. But here's the flip side: a loan isn't a gift. Those monthly payments, they're non negotiable. Rain or shine, job or no job, interest is the price tag for borrowing, and it can add up to way more than you expected. And if it's a secured loan, your house or other assets on the line are on the line if things go wrong. And if you miss payments, you can expect fees, penalties, and a dent in your credit record that lingers. And credit score is very dangerous if you mess it up. So loans are powerful tools, but just like power tools, they can build something amazing or cause a real mess if you're not careful. Interest rates are like the rent you pay for, borrowing money. And just like the rent, the higher it is, the more it eats into your budget. Now, the annual percentage rate, or the APR, is the real number to watch. It takes the basic interest rate and adds in fees and costs, giving you the full, ugly truth of what you actually pay each year. Some loans use simple interest. It's straightforward. You only pay interest on the original amount you borrowed. So, as you chip away at the principal, your interest costs shrink. Others rack up accrued interest. It builds over time, due at regular intervals like monthly or quarterly. Miss those payments and it snowballs. Then, finally, there's compound interest, the sneaky one. Here, you're not just paying interest on your loan, but on the interest you already owe. Left unchecked, it can turn a manageable loan into a budget nightmare. Something that keeps you up all night. Ever wonder who actually decides how expensive your loan will actually be? It's not just your bank pulling numbers out of thin air. There's a whole chain of decisions behind their percentage. At the top, you've got central banks. In the US, that's the Federal Reserve. They set benchmark rates to keep the economy balanced. If inflation is running wild, they raise rates to cool things down. If growth is stalling, they lower rates to make borrowing cheaper and spending easier. Then come the lenders. They take that benchmark rate and add their own margin based on your credit score, the size of your loan, and what type it is. Better credit and stable income? You'll likely get a better deal. Riskier profile? Expect to pay more. In the bigger picture, low interest rates make borrowing and investing tempting, sparking economic growth. High rates slow things down, which can help tame inflation, but at the cost of spending and investment. When it comes to buying a home, most people don't just pull out a suitcase full of cash, they get a mortgage. Think of a mortgage as a special kind of loan designed just for real estate, where the property itself is the collateral. Typically, mortgages last for 15 to 30 years, letting you pay off a big purchase bit by bit over time. Your monthly payment usually bundles several things: the loan principal, interest, property taxes, homeowner's insurance, and they're all wrapped into one neat package. Just like other loans, mortgages come in different flavors: fixed rate for steady payments, adjustable rate if you want something that can change with the market, or government backed options for those who qualify. Getting a mortgage isn't just about dreaming of your new home. Lenders want proof you can actually pay for it. So, how did they decide if you qualify? Well, first up, your credit score. Most lenders look for at least a 620, but the higher your score, the better your chances for lower interest rates and friendlier terms. If your credit's shaky, expect more hurdles or a pricier loan. Next, income verification. They'll ask for pay stubs, tax returns, and sometimes even extras like bonuses or child support. They want to see steady, reliable income, basically proof you can cover those monthly payments without breaking a sweat. Then comes the down payment, usually between 3% and 20% of the home price. The bigger your down payment, the less you borrow. Plus, putting down more can help you avoid private mortgage insurance, saving you money every month. Finally, the debt to income ratio, or DTI. This compares how much debt you pay monthly versus how much you earn. Ideally, it's under 43%. Too high, and lenders get nervous, and you might struggle with new payments. Getting a mortgage might sound complicated, but breaking it down step by step makes it way less intimidating. Here's how it usually goes. First, there's pre-approval. This is where lenders take a quick look at your finances to figure out how much they might lend you. It's like getting a head start on your budget, and it shows sellers you're serious. Next comes house hunting. Armed with your pre-approval, you can confidently look for homes in your price range and make offers, often with contingencies like inspections or appraisals to protect you. Once you find the one, you submit a formal application. This means handing over detailed financial docs and info about the property to your lender. Then, the underwriting phase. Lenders dig deep to verify everything and assess the risk. They'll decide whether to approve, deny, or ask for extra conditions. Finally, closing. This is the big day when you sign all the paperwork, pay closing costs, and get the keys to your new home. It's the finish line and the start of a new chapter. Loans and mortgages are powerful tools that can help you reach big financial goals, whether it's owning a house or investing in your future. But with great power comes great responsibility. First, you have to choose the right loan by carefully weighing types, terms, and interest rates so it fits your unique situation. Secondly, you need to understand all the costs involved. Interest rates and fees add up, so knowing what you're really paying upfront is key. Thirdly, prepare well for mortgage approval. Keep your credit score healthy, maintain steady income, and save up for a down payment. And finally, follow the process step by step. The more you understand each phase, the fewer surprises you'll face, making approval smoother and less stressful. With the right knowledge and responsible planning, loans and mortgages aren't just debts, they're stepping stones to a stronger, safer financial future. I'm Mauricio Chakravarti, and this is Creating Lasting Investments. If you liked the video, please subscribe, and thank you very much.